Have you ever seen a headline about some company's record-breaking profits and just kind of wondered, is that the whole story? Well, today, we're going to decode the universal language of business, accounting. And I'll tell you what, it's not about spreadsheets. It's about telling the difference between fact and fiction. We see these headlines literally all the time, right? Companies smashes profit records, or tech giant reports explosive growth. And yeah, it sounds exciting, but it brings up a huge question. So, how do you really know if those incredible numbers are legit? I mean, as an investor, or even if you're just curious, how can you be sure what's actually happening behind the scenes? Well, the heart of the problem is this concept called information asymmetry. Just think about it for a second. The company insiders, the managers and executives, they have the complete picture. They know everything. But the public, us, we only get to see what they decide to show us. And that gap in information, that's where all the risk and distrust starts to build up. So how do we bridge that gap? How do we build trust? We do it with a system, a shared language that was specifically designed to level the playing field for everyone. And that solution, at its core, is a financial information system. Now, that might sound complicated, but the best way to think of it is as a universal translator for business. Its only job is to take all the complex, messy stuff happening inside a company and communicate it clearly and reliably to the outside world. And here's basically how it works. First, you've got the input, every single sale, every purchase, every economic event. Then comes the process. The system takes all that raw data and records it, sorts it, and summarizes it. And finally, you get the output, the financial statements that tell the real story of the company. It's a pretty powerful process that turns total chaos into clarity. And look, this system isn't just some abstract idea. It exists for real-world reasons. It's there so investors can make smart decisions, so owners can hold their managers accountable, and so regulators can make sure it's a fair market for all of us. It has a vital purpose. But here's the thing. For any language to actually work, it has to have rules, like grammar and syntax. You can't just make stuff up as you go. Well, in accounting, these rules are called accounting standards, and trust me, they are not negotiable. To show you why this is so critical, let's just zoom in on one perfect example. It's just one rule, but it's a huge one. Accounting Standard 9. It's the rule that decides when a company can actually say it's earned revenue. Okay, so imagine this company, we'll call them Build It Corp. They get a massive 10 lakh rupee deposit for a crane. Now, the temptation is huge to book that cash as revenue right away to make their quarterly report look amazing. But AS9 steps in and says, whoa, not so fast. You can only recognize that revenue when the crane is actually delivered and the customer officially owns it. This one single rule stops companies from massively inflating their sales figures. All right, so now that we've got reliable numbers we can actually trust, we can start to analyze them. This is the fun part, where we get to play detective and give the company a little financial health check. And our number one tool for this is something called ratio analysis. Honestly, it's just like a doctor's checkup for a company. We're not just looking at one number by itself, we're comparing different numbers to see how healthy it really is overall. So let's use an example. We'll look at a company called Fast Move Logistics. First up, we'll look at their current assets, which is basically cash and other things they expect to turn into cash within a year. Let's say that's 50 lakh rupees. Next, we look at their current liabilities. These are the bills and debts they have to pay off within the next year. And for them, that's 25 lakhs rupees. Just looking at the two side by side, you can already get a good feeling. The assets bar is double the size of the liabilities bar. That right there is a really positive signal that they can cover their short-term debts. And here's the actual math. We take the current assets and divide them by the current liabilities. So 50 lakhs divided by 25 lakhs gives us a current ratio of 2.0. So what does that mean in plain English? For every 1 rupee they owe in the short term, they have 2 rupees in assets to cover it. A 2-to-1 ratio like that is generally considered very, very healthy. Okay, now for our last and maybe the most critical concept of all. It's something that fools even experienced investors. The profit a company reports is not the same thing as the cash it has in the bank. So let's check out the puzzle of Neo Power Ltd. You look at their profit and loss statement, and it's glowing. A net profit of 100 lakh rupees. Amazing! But then you glance over at their cash flow statement, and you see that their actual operations are burning through cash. It's negative. So how is that even possible? Well, here's the deal. That profit includes a bunch of sales they made on credit where the customers haven't actually paid their bills yet. So the revenue is on the books, but the cash is not in the bank. And at the same time, the company spent its real hard cash buying things like new machinery. See, the cash flow statement tells a truth that the profit and loss statement can sometimes hide. And this gets us to one of the most important rules in all of business. You can be profitable on a spreadsheet all day long, but if you run out of actual cash and can't pay your bills, you will fail. There's a saying, profit is an opinion, but cash is a fact. So when it comes down to it, accounting is so much more than just bookkeeping. It's the fundamental system that allows our entire market to work. It's the shared language that builds trust between companies and the rest of us. Which really leaves us with one final thought. The next time you see headlines celebrating a company's incredible profits, you're going to know better. You won't just take it at face value. The first question you'll ask yourself is, that's great, but are they actually generating cash? And asking that question, well, that changes everything.